Hi everyone, I'm Hadi Shafiq here from SmartFX. I'm delighted that all of you can join me for the webinar that I'm going to do today. So let's begin. First, let's get rid of the formalities. You can follow us on all of our social media pages: Facebook, Twitter, LinkedIn, Instagram, YouTube. And as you can see, there is my personal WhatsApp number over there. You can text me anytime you feel like it. Don't hesitate. Anytime. I'll attend your texts. Let's begin. An introduction to Forex risk management. This is an extremely crucial point of Forex because it is beyond just simply technical analysis or anything, because this is basically how you're going to manage your funds, how you're going to manage your portfolio, how you're going to diversify your portfolio. In this complete PPT, we will go over various different methods and at least give you a new insight of how to manage your money in the Forex markets. It is not as complicated as people make it to be. It's very simple. Basically, you need to understand yourself. You need to understand a little bit about the market, the assets you're trading in, the volatility involved in the market, because you might have a lot of mixed opinions and a lot of hearsay that Forex is this and that. Okay, markets are volatile, investing is risky. It all goes back to risk management. Technically, no investment is too risky. It is all how you have managed it, how well you are financially, how stable you are. So if you look over here, the Forex part of this, we're going to go over in this PPT basically. So the reality is that the whole world focuses more on signals. Well, it shouldn't be like that. They should focus on risk management. That way, it is very much safer. Because what happens usually, anyone gets interested in Forex, he opens his account, starts trading without any knowledge about risk management and what even risk is in this market, what he's even doing with the application, with the platform. And that way he can even incur a major loss. And that's the thing what we will try to guide you with so you can avoid it, because that is basically investing, avoiding major losses and trying to consistently build a portfolio through a matter of time. It's as simple as that. When people try to rush it in, try to get results quickly, have unrealistic goals, that is where the mess up happens. So this complete session will teach you, or at least give you an idea what are the common mistakes newcomers are making. So I'm really excited to tell you guys more about it. Let's go fix that. Understanding Forex risks. There are multiple types of risks in the broad spectrum. You can include that there is exchange rate risk, there's interest rate risk, there's credit risk, country risk. The most common is exchange rate risk. What is exchange rate risk? It's simple. For example, if you take it on a macro scale, when you're doing business in a way internationally, and you have to deal with goods which are not in your local country, it's in a foreign country. So you have to sell your home country and buy the foreign currency. In that situation, you are exposed to risk. So what if that the foreign currency becomes stronger? It will take more of your local currency to get it, to buy the foreign currency. So that is what exchange rate risk is basically. And it can go into various other methods also. I'll give an example, short, quick. I'll try to make it quick. Let's say you are a businessman. You want to buy €1 million worth of goods in somewhere in Europe, and you are trading from, let's say, America. So your local currency is dollars. Let's say that the time you want to make this transaction or you want to get these goods, the exchange rate of euro versus USD goes higher. That euro becomes stronger to the dollar, let's say by 2%. And let's say the goods are worth €1 million, yeah? So in just a matter of a day or 2 days, euro became 2% stronger. So when you send these dollars to euro, what will happen is you will have to pay 2% extra. Because if you think about it, now each euro costs is higher 2% by 2%. So that thing has already eaten $20,000 worth of your profits. So that is what an exchange rate risk is. And people don't realize it. It is always around us. There are certain strategies people use to avoid it. We will elaborate that later. But I'm just giving you an idea right now. It can be exchange rate risk can be further divided into transaction risk, translation risk, and economic risk. So the thing I just explained, that transaction risk arises from the possibility that a company may lose money on a foreign currency transaction due to an exchange in exchange rates. That's what we went through right now. Now, translation risk, something different now. What is that? That is when, for example, you're a business owner again, and you have your financial statements in dollars. When you give it to some auditing firm or you do it through some other various method, and you, for that reason, you have to change the base currency of your statement, that is a translation risk, because you have translated, let's say, for example, I have a statement, it's based in dollars. If I want to translate that into euros and convert that into euros, that itself has translation risk, because again, exchange rates, they are volatile. So a dollar is valued different than a euro, and they're constantly moving. So that type of situation has a translation risk. And last but not least, economic risk, that is affected by like all our world leaders, policymakers. We call it macroeconomics basically. So when governments, policies, congressmen, parliamentarians in many countries, they release new policies, or they hike up the interest rate, or they do something fundamental which affects the market, that directly affects the currency. If tomorrow America announces that they're going to increase the rate by 100 basis points or like 50 basis points, that will have a drastic effect on the currency, and every currency it is trading against instantly. Sometimes a little bit of delay, but most of the time instantly. And when your interest rate goes higher, the currency obviously becomes stronger. And then there are other macroeconomic factors which also play in. So simply, exchange rate risk, transaction risk, translation risk, and economic risk. This is something extremely crucial, and the one thing I was more excited to talk to you guys about, identifying your risk tolerance. As you can see in this chart, it ranges from low risk to high risk. So there's conservative, moderately conservative, moderate, moderately aggressive, aggressive. Let's talk about conservative first. When you have a mindset, when you're thinking something like, I need to see at least a little return, even if you're not beating inflation, like on a monthly basis, you're being conservative. Okay. And let's go to the higher level, moderately conservative. And let's say your mindset is, I have had some time, I have the ability to afford a couple of losses and this and that. Then you're heading towards the more aggressive side, and you're considered moderately aggressive. Moderate, that you are adamant that, okay, even a small or medium loss is fine by me. And aggressive trader, what is their mentality? I don't mind if I lose money. So these are different types of mentalities. Each have the capability of making money. Each can also incur a loss. But the way it shifts is when you go towards an aggressive approach, okay, considerably, when you take any investment and you go aggressive, the risk of losing money increases, but the risk of making money exponentially increases. That's like a trade or a bet that you have to be willing to make if you are only like sound-minded, you're at peace, or you have enough money, enough disposable income. That is the only time where you can think or do something like that. And if you take the other end of the spectrum, conservative, let's say you're just an average person, you have a salary or a monthly income, you have certain expenses you have to take care of, and apart from that, you have, let's say, a couple of $1,000 left over, and you want to trade that. So obviously, you'll be more careful with that. So what you are going to do is you're going to take less risk on that. That is the conservative approach. And all of these approaches, it's not that it's right or it's wrong. It's just based upon your situation. And the reality is that you need to identify your own risk tolerance. That's the name of the topic over here. So in that, you have to assess that basically, okay, am I financially well off? How much disposable income do I have or cash do I have? Am I liquid? Am I illiquid? Do I have any upcoming expenses, major expenses? And after thinking about all of this, understanding your situation, then you can take the approach. So any person, even if someone, if you've known someone like he has been risk averse his whole life, there's a thing called being calculative. Calculated risk is something very interesting. Let's say, for example, I make $20,000 every month. Okay, I'm a good stable guy. I have my house. I have everything well settled. My family is doing good. Everything is fine, and I don't even spend a lot of money. Like a lot of my money is saved up, or it's like somewhere. So that makes me more affluent. So what I can do is I can keep a bigger capital. I can invest it. I can risk it. I can even gamble it to the point, and it will still add up to my risk strategy. Because, for example, if I'm trading something and I think, okay, I will invest $10,000 in this specific thing, but the return possibility on that will be 5x or 10x, but it will have an aggressive chance of going negative. But if I'm comfortable financially, I can take that. And that is, you can say it's like a superpower. On the other hand, now let's say I am a simple, normal guy, only a couple of $1,000 a month, and I have a couple of $1,000 saved up also, and I want to start investing to generate some sort of like a return. So to that type of person, we would never suggest that he takes the aggressive approach, because he cannot psychologically afford it, he cannot financially afford it. So in that type of situation, what will happen is when you place a trade or you invest it somewhere, every second you'll be looking at the phone, mobile, at the gadget, and again, you'll be thinking about it. You will lose sleep over it. So having that type of situation and going aggressive is completely wrong. Being more conservative in that situation is the intelligent thing to do. That I will not let my greed get the best of me. I will think more towards like, okay, I want to just create another flow. I want to start this thing. I want to start learning this thing. Because all the time, you cannot just be looking at the market, reading books and learning. You need to actively trade the market or invest. You have to test your metal. That's how it is. So it's considering your situation, how it is. You need to identify your own risk tolerance. As I was saying, your financial situation, investment goals, personal temperament. I left that part, I'm sorry. Personal temperament. That is extremely important because it's psychological. Trading is not just charts, analysis, money, and just fund managers or like companies. No, it is completely psychological because the way you behave after you place a trade, that is more important than the signal you get, than anything, because you need to have a lot of patience and you need to create that atmosphere, create that trade. For example, if I know that I cannot absolutely handle risk and I go in for an aggressive trade, I will lose my mind. So we have to focus on not doing that. We have to take a simpler approach and go easy on that. That's the point. Psychological part of trading is extremely real. It is not talked about a lot, but you need to have basically control over your mind. It's almost spiritual if you think about it. So setting risk management goals. It says over here, without clear and realistic goals, it can be difficult to manage risk effectively. And that is extremely true. Now, if I take a certain amount of money and I think that I'm going to 50x it, 20x it, or 10x it in a month, and I just heard that the Forex market is outstanding and this investment is good, and I just put money into it, that is setting up an unrealistic return or an unrealistic expectation. That is not how you should approach. So the way to get the ball moving or get the momentum actually is very simple. Let's take an example. You go like you have $10,000, you put in an account and start trading. You think about getting your first $100. Doesn't matter if it takes 1 day, 2 days, 3 days. In Forex, it can be done way quicker. But you need to take the time and you need to take the proper approach to not incur any major losses. So when you go towards like, okay, I'm gonna in my initial week, I don't want to speed things up. I want to make my first $100 or $200. That is setting up a realistic approach. And then you can go towards your next approach that, okay, next week I'm gonna make $300. On the third week, try to make $500. Now the thing is, in these weeks, you will have losses, you will have profits. You have to just make sure that the net is going positive. So you need to set realistic goals. That's how it works. Otherwise, it will lead to disappointment. For example, if I just put 10,000 and say, I want to make $5,000 in this week. When I try to go for something like that, I risk my capital, my finances, my situation, my peace of mind also. So that's the thing which you need to avoid. And a lot of beginners do this. You know, there are so many people who don't know anything about the market and they just jump into it. And that's not how it's supposed to be. It's supposed to be you take one step at a time. If you have the capital, good, but don't go aggressive on the trading side of it or the investing side of it until you have enough knowledge, or at least you understand that this type of a loss can incur, that this type of a situation can happen. But obviously, you learn by doing. So better do it slowly. That way, you won't have any major losses. One effective way to set your risk management goals is to use the SMART framework. It's an abbreviation basically. And it stands for specific, measurable, achievable, relevant, and time bound. Well, basically, in any way of life, once you create a discipline, once you create a system, a routine, your chances of succeeding goes up by a big percentage. So that way, if you look at it, if you create a framework, and this is one which is already made, you can use this. So whenever you use such type of time frames, framework, it is simpler for you, but you need to adapt to it and to create a discipline towards it. And again, with whatever framework you use, you need to have realistic goals which are achievable, and you will gradually grow your portfolio. And that is definitely going to be more fun than just starting with some sort of a loss. So you can keep this in mind. You can use a framework, you can use this one, you can create your own, some sort of discipline. You know, certain time frames you follow, certain days you follow, certain days you won't trade, certain days you won't look at the market. That is creating a healthy relationship between you and the market. And that is one of the best things you can do. Because the thing is, if you take this carefully, steadily, intelligently, there is no limit. It's literally limitless. It is the biggest market in the world. Okay, this is very, very, very important. Using stop loss orders. So what are stop losses? It says it in the name, stop loss. So when you open any sort of position in commodities and Forex and stocks, what happens is you have the ability to set a stop loss. For example, I open a position and I think that, okay, if I lose $100 on this position, I want it to automatically execute, as in to cut and loss. I'm fine with the $100 loss or $50 loss. I don't want it to grow further. So in that situation, you use a stop loss. This helps you attain better peace of mind, to be honest, to be frank. So what happens in that situation is that you can place the trade and then you can go around even, focusing on other things. And while you're focusing on other things, your trade is actually, it's basically calculated. So whatever happens in that situation, if anything, any news comes out, suddenly some unexpected data comes out, anything happens, at the back of your head, a stop loss is set. and I won't lose a lot of money. I just have prefixed the number. So using a stop loss is extremely crucial. It's very important, and it is highly, highly recommended for beginners to use it. There are some people who can trade without stop losses, but they're towards advanced levels and they have different strategies. But initially, being a beginner, you have to use stop losses because it is going to save you a lot of money, a lot of despair also. There is another part of stop losses. So what happens is initially when you enter a trade, what you can do is, let's say your trade has gone into profit. For example, let's say I'll take an example of gold that I entered at $1,800 an ounce, and it is trading at $1,820 an ounce, 1820. So what I'll do in that situation is that I can set a stop loss at 1810, which is $10 above my actual buying price, because it is $10 below the spot price. So in that situation, what happens? The worst case scenario for you, what becomes is that your position will cut in a lesser profit. If you ask me, that sounds outstanding, but it does not close the position. It leaves it open. So you've set the stop loss at a lower level. Even if the market goes towards that or it spikes suddenly towards that, what happens is that your position will be cut in a certain profit or half of the profit, which you're already seeing on the screen. You have to basically, it can help you manage your profitable trades even better. Because sometimes when markets are trending, the market just goes one direction, it runs away. It keeps on following the trend. It went to 1820, then it goes to 30, comes back 25, pushes further. In that situation, there's another thing called a trailing stop. So trailing stop is a little more complex than a normal stop loss, but it does the same job basically. So for example, let's say market is an uptrend. From 1800 went to 1820, it's going up. Okay, now you're a buyer and you have one position. So what you do is simply that you place a stop loss, a trailing stop at 1810. You set the parameters, and what happens is, as the market goes higher, the stop loss, which is placed at 1810 on that specific position, it will go higher with the market. And if it goes lower, it will not go lower. So let's say the market breaks through and keeps on going up from 1820 to 25 to 35 to 40. That initial stop loss, which was on 10, will automatically come up to 25 or 30 or somewhere around that. And if the market suddenly spikes for a reversal or something, and it breaches that point, it will cut the position at a much higher rate. And it's going to help you make much more money, much more ROI on the trade, basically. So that's something which is called a trailing stop. And by the way, one more thing, sometimes when the market is fluctuating extremely fast, you don't have the time also to cut the position. In those situations, if you have a stop loss, it is better, much better, because it's the machine working for you, basically. Because the machine will cut the position quicker than you can. So if suddenly you have a position and the news comes out and the market explodes to the opposite side, so instead of completely, holding on to the complete loss, you have a smaller percentage, a 10 or 20%. For example, like you open a position and your goal is that you will only lose $100 and you don't set a stop loss and the market suddenly fluctuates a big move, 2-3% down. That might help, that might get you a $1,000 or a $1,500 loss. But once you have a stop loss set, it is already prefixed, so you will not lose more than 200 or 250 or whatever your fixed amount is. So again, using stop losses, especially for beginners, is very, very, very important. Implement position sizing. This is where you will get the finesse of the market, the way you can, trade it basically. So in this situation over here, you can see that there are 4 micro lots. Okay, let me just simplify for you. It's a 4,000 unit position. So 4,000 GBP USD. So the person is trading this. What happens in this situation is that he has set the risk percentage at 1%. The stop loss is at 50 pips. That's a moderate movement. Account balance is $2,000. So at this position when there are 4,000 units bought and the market moves 50 pips, which is you can say almost half a percentage, that translates into $20 worth of loss. So they are already prefixing it, as you can see. The stop loss is at 0.5 percentage or 50 pips, $20, and that is how you can manage your stop losses. Also, but if you look at this, imagine you have bought 4,000 units of GBP USD. Okay, it means you are a buyer in pound, you're a seller in dollar. You want the market to go up pound. When you have 4,000 pounds, even if it goes down 2%, 3%, or let's say, for example, something major happened and it goes down to 5%, that is such a small position. It can not cause a big drastical effect on your net worth or your account size. Because if it goes down, let's say you have $4,000 and you bought £4,000 worth of position, what happens in that situation is you're only going to lose, let's say, 1% or 2%, or let's say 5%. That's $200. So in the same scenario, if instead of 4,000 units, you would open 40,000 units, that would change things drastically. Where you're seeing a $20 stop loss in this small movement, you will have a $200 stop loss. And if there are any sudden movements, it will cause a big effect on your account. So position sizing is extremely important. Why? It helps you manage the risk. And on top of that, if you're using stop losses on that, you are on the way to become a really good trader. And if you understand this from the beginning, it is excellent. Diversifying your portfolio. It is a key in all of investing. That diversification is one of the best things you can do. It is the way you can keep the same return with lowering the downside. So I bet you must have heard already that you don't put all your eggs in the same basket. It's something similar to that. That example was basically made for diversification. So when you just trade one thing or one currency, or you put all your money in one pair, you are, in that sense, you're completely risking your account on one pair. But if you spread it across, let's say you are going to trade American currency with some other currency, like you trade pound and dollar, okay? And then you can take some other currency like the Asians or the Aussies. You're diversifying your position. So instead of opening a big or a moderate position in one simple currency, you can open it multiple places and in different areas. It's more like an intercontinental approach if you think about it. Because what happens is if dollar moves certain like to a certain level, it affects naturally to all of its output. Like if dollar goes stronger, generally it goes stronger against everything. But when you're trading, let's say part of it in dollar and you have the other part, let's say in Australian dollar or some other Japanese yen, which is not trading against the dollar. So let's say it's Australian dollar against the Swiss franc, CHF, AUD versus CHF. That pair will not be affected by what happens to dollar. So in that way, if something wrong is happening in dollar, you don't need to worry about it because you know you have the other position in AUD CHF in a cross currency. That way, if you take an approach towards multiple other currencies and you trade them, it is way less risky than just putting all your trades in one basket. That's the initial approach, basically. So there's the odd Japanese yen, there's odd CHF, then there is Euro GBP. There are many cross currencies which you can trade, and it will help you lower the risk. One of the most popular methods used by everyone is technical analysis. It's basically you're seeing the historical levels of the prices, what prices were 1 minute ago, 1 hour ago, 1 day ago, 1 week ago, or a month ago, and you're using some sort of technique, some sort of indicator, some sort of method to predict what's going to happen in the future. Technical analysis is an amazing way to manage your risk. Why? You have thousands of hours of data backed up by news and fundamentals, which you can analyze and think and logically come to a conclusion of what is going to happen next. See, there are basically many indicators. There's thousands of indicators now, but basically the originals or the classics which still stand today, the RSI, Bollinger Band, moving averages. Bollinger Band is basically a moving average with a deviation mimicking. So the way people trade, there will be like three strands. The middle one is the deviation. The bottom one is when the price touches the bottom one, you buy. If it breaks the bottom one, it's better not to trade that. And if it touches the top, you sell. And if it breaks that, it's forming a new thing. Then that goes towards analysis, because you have to see that in that time frame, in that period, has that been relevant? Has that Bollinger Band which you're using, has it been used? So how you can do that is, don't use just one simple indicator. You can use multiple together, and you have to get logics in place. Use multiple logics at the same time. And when you are always arriving in the same conclusion that if it's a buy or it's a buy or it's a sell, then you can go for the trade. You don't need to just jump into the trade. So the RSI, it will show overbought and oversold levels, and it is widely used till date. So there are three levels actually. The classic has two, but people can use three also. There's 30, there's 50, and there's 70. So 50 means it's the medium area, it's the middle area. The market is neutral. Once in the RSI, the market goes towards 70, it means it's overbought. And if it goes towards 30, it's going to be oversold. So overbought territories tend to fall. Oversold territories have a retracement, a strong one many times. The bigger the time frame, the bigger the retracement. So RSI is basically, it's going to show you momentum. That it's not necessarily that if the graph is going up, but the RSI will show you that the graph is going down. In that situation, let's say if the price is going up and RSI is going down, it is giving you an indication that the momentum of whatever trend is going on is diminishing. So you can use that to your advantage. And again, you should use multiple indicators together to form a better trading strategy. So basically, yes, technical analysis is something which works, and obviously you should definitely use that, but it comes with patience. It's not like I will just jump in with my trading account and think that, okay, next hour or like in the next couple of days I will know how to trade. No, it takes dedication, it takes hard work. You have to be dedicated, that every day you dedicate some time to it. You are going to watch and you're going to see how the market is reacting, what new patterns are, the market is forming. So you have to take your time and you have to be in the market. You cannot just have simply like a demo account just to learn that. No, when you are completely invested in it, okay, when you have real money at stakes and then you're paying attention, that is where it will make an effect and you really have that grasp. You feel it. And then the psychological factors come in, you learn how to battle it. You learn how to be patient. You learn how to deal with the stress. And it's all part of the trading. It's all part of investing. It's all part of, learning how to grow your wealth, grow your portfolio. Because eventually everyone does have to take a little bit of risk for growth. And that can be applied everywhere. You can see the names of Bollinger Bands, Alpha Strength Index. There are hundreds. There is like MACD, there's Heiko, there is Gecko, there's a way of charting. There are many theories. There's one called Elite Wave Theory. That is very good. It's just up to you which strategy, which indicator will work for you, your temperament, your ideology, your risk management, and you have to take it from there. Do not get confused because there are too many. You should pick a few and start experimenting, and then afterward, you will start to understand the market better. You should keep in mind there was a time where charts did not exist. People should trade without all of this. To be honest, those were simpler times. Now this is, I consider this is a dangerous part of it, the fundamental analysis. It is a powerful tool, and you have to be very careful because this is where like geopolitical issues come across. So fundamental, see, technical is the chart part of it. Fundamental is towards the policies, the interest rates, how much cash is there in the economy, what is inflation doing, how is unemployment coming through. All of these various factors kick in, and these things can trigger a massive move also, as well as it can create certain boundaries, it can create certain psychological price levels, which it takes time to break. So you need to be a bit of both. You need to know the technical part of it. Okay, that's great, but you need to also have an idea of what are going on in the fundamentals. What's the news? What is the president of USA doing? It all depends on which currency you're trading. So when you are trading Australian dollar, then US news won't affect Australian dollar so much. But if you're trading US dollar, you need to know what their presidents are doing. You have to go by whatever the news is going on, and you have to stay updated. That's the fundamental part of it. And you need to get a little bit comfortable with these keywords like GDP growth, economics, and unemployment rate, CPIs, PPIs. Then there is PMI, managers index. A couple of things. It'll need a couple of days of research, but you will get the grasp of it. And these things directly affect, because when policymakers change things, it hits the market instantly. It is extremely important to be aware at least. And at the end of the day, when you are managing your risk, you should not be afraid of this part. There are some traders who only trade fundamental, they don't even see the chart. There are many traders like that, and there are people who make a lot of money doing that, but that is risky. It goes back to how much capital you have. So those people usually use a lot of money. I'm talking hundreds of millions and a couple of billions. So fundamental analysis, you need to know more about it. Yes, for sure. After all is said and done, and you see your trades day in, day out, you see your technical analysis, you see your fundamental analysis, throughout periods, days, and weeks, you should keep a track of all things. You should even have a trading journal if you can. It's a very good practice. You can mark down the specific trades you want to track. You can get chart patterns and stuff. You can create that just to memorize it. And after certain periods, you have to retest your strategy. Check, are you making that return? Is it effective? Is it working for you? The challenging part of the market is that it keeps on evolving. So what the market does today, it does not guarantee that it's going to do tomorrow. And what it does tomorrow does not guarantee what it does the day after that. So you should always think about that. And it is extremely, extremely challenging to keep up with the market, but that's where the game is. Because if you stay ahead of the curve and you keep on evolving and keep on checking yourself in the journals and every way possible, you're eventually guaranteed that you're going to become a good trader. And if you don't do that, it becomes more tricky. You have to train it it's like a way of life. It's a part of your life, and you have to work by that. It's adjusting your risk management strategy, basically. Monitoring yourself is critical. And common mistakes are not one of the most common mistakes is not having a clear understanding of what your risk tolerance is. That's what we have spoken about throughout this webinar. So when you are doing poor management trades and taking extra risk, that leads to furthermore poor decision making, and that leads to furthermore losses. So you should be careful of that. And it's better to avoid the common risks, which we have talked about, that you don't need to basically make, because what's the point? If it starts up in a negative way, you will be disheartened. But there have been a lot of traders that have started trading and they made a lot of mistakes, and they took the time and they took the patience, they had the patience basically, and they went on with it and then later on became extremely successful. So again, the psychological part plays in. You need to be very careful and you have to be sound-minded, basically. If you are under like financial stress or something like that, it's better to avoid it because it is not a plus point, basically. So you have to keep your eyes open all the time. Not using stop loss is one of the biggest mistakes newcomers do. And that is what I will also personally highlight, that if you're a new person, you have to go by this. After you gain understanding, you can stop using them, but that's how it is. So you have to use stop losses. So one of the common mistakes you can do with stop losses also is that you set them too close or you don't use them at all. So what happens in that situation when the market gets a little volatile, you keep it like a 30 or a 40 pip away stop loss, and the market triggers that, and you get it again, and it triggers it again, and you get it again. Sometimes you have to keep the stop loss at a decent distance and try to like mostly you have to keep a good distance also. Sometimes it's applicable that you can take a smaller or a shorter position in like a tight stop loss or something, but doing it again and again doesn't make sense. So you should be careful of that mistake. I guess this is it. If you did not follow us in the beginning, I hope you like this webinar, so you can go follow now. Any social media we are available. And again, feel free to contact me. Hadi Shafiq signing out. Bye.